Have you ever wondered how a small state like Mizoram gets funds for roads while a giant like Maharashtra pays the bills? Or why Tamil Nadu, despite performing better, receives a smaller slice of the fiscal pie? Welcome to the most powerful tug of war in Indian federalism, where politics meets economics and the constitution plays as a referee. Today, we will unpack the most relevant, most misunderstood, and most exam worthy topic in the Indian economy, that is the center state financial relations. If you are a UPSC aspirant or just curious how India's economic engine runs, you are in the right place. This is Narayana, and you are watching Learning Through Thalaivar Way. Hit subscribe and let's begin this journey where taxes meet truth and grants meet governance. Here's what we'll explore today: a 360-degree coverage of Indian fiscal federalism, constitutional provisions, role and functioning of finance commission, grants in aid, GST's impact on state-center relations, key issues in fiscal federalism, reports, commissions, and also discuss the PYQs for UPSC. Stay till the end. What you are about to learn can win you marks in prelims, boost your mains, and also impress in interviews. So let's get into the lecture, folks. So first, we'll start with the constitutional provisions. The Indian Constitution in Part 12 of ranging from Articles 268 to 293 outlines or is the blueprint of India's fiscal setup. So let's simplify this. Actually, Article 68, it says taxes levied by the union but collected and appropriated by the states. That is, it is put by the union but states collected. So a good example we can say on Article 268 is stamp duties. Next is Article 269. Union levies and collects it but assigns to state. Like, it is put by the center and collected by the center, but it assigns to the states. Interstate sales tax. Interstate sales tax is an example. Next one is Article 269A, a special provision for goods and service tax on interstate trade or commerce was introduced after the introduction of GS2. Next one is Article 270. Here, union levies, collects and shares the revenue with the states. Okay, that is Article 270. Keep it simple. Taxes are levied and collected by the union and also distributes between the states. Shares the revenue with the states. Article 271. Parliament can levy surcharges on taxes and duties. Okay, but it's not shared with the states. Union keeps it for its own use. Article 275 provides for statutory grants in aid to states that are need for financial aid. Actually, it's recommended by Finance Commission and it's not votable. Next one is Article 282. Enables both the union and states to make discretionary grants for any public purpose, even if it is not within their legislative competence. Like, for any public purpose, it can be like be it building roads, schools, or whatever it can be, for any public purpose. So it doesn't matter. So hope you guys are clear with the articles. See, these articles are like the India's financial traffic signals: who pays, who collects, and who decides. So these are India's fiscal fault lines and guardrails. So always try to master them. So moving on with the Finance Commission. Think of the Finance Commission as the chief umpire of fiscal federalism, or which is established under Article 280. The Finance Commission is like the Rajinikanth of fiscal federalism, powerful, balanced, and also very essential. So, what is the composition of it? Chairman, the visionary leader, he is the chairman. At the helm is the chairman, who is not just a bureaucrat but someone with vast experience in public affairs. This person must understand India's economic heart and the political pulse because he presides over discussions, frames the approach paper, and coordinate between the center and states members with knowledge of law, finance, economic administration. Everything must be there. Now, what is the four members, the think tank team, or the members of the other members of the Finance Commission? See, they are just not handpicked, they are carefully chosen to reflect the balance, diversity of knowledge and experience. Let's dive into who they are actually. A judge of a high court or even qualified to be appointed as one. Why a judge? Why should we appoint a judge in a Finance Commission? Because the Constitution wants someone to understand justice, especially fiscal justice. This person makes or ensures the principles of equity and legality aren't compromised. That's why judge is appointed. Next one is a person with special knowledge of government finances and accounts. This expert here knows how budgets breathe and how bad accounting can paralyze policies. See, that person brings in technical insights into revenue collection, expenditure frameworks, and audit practices. Next is someone with wide experience in the financial administration. See, this is the bridge between numbers and governance. They understand how the schemes are implemented, what bottlenecks states face, and how reforms actually play out on the ground. So this is something which the third member brings. And the fourth one is an expert in economics. The economist is the soul of the commission. They study growth, inequality, inflation, debt sustainability, and give shape to the big picture. Because money is not just about maths. It's about law, justice, delivery, and economic vision. This composition ensures that all these aspects are weighed before recommending tax sharing or grants. And that's why UPSC always loves asking about the structure, because it reflects the spirit of cooperative federalism. So hope you guys clear with the Finance Commission. As you all know, it's a constitutional body, and the current one, the 16th Finance Commission, is led by Dr. Arvind Panakriya and will impact the next 5-year plan from 2026. Now, how the members are appointed and what are the functions? Okay. Now that we know who's in the Finance Commission, let's talk about what they actually do, or better yet, what only they can do. Appointed by whom? They are appointed by the President of India every 5 years or even earlier if the need arises. But what's their real power? It lies in their ability to shape how the center and states financially coexist. So that's something the members of the Finance Commission do. Now, what are their functions? Vertical devolution. Like, how should the tax pie be split between the center and states? Okay, this is like deciding how much your parents give you out of the household income. Right now it's 45%, but this number has evolved over decades. Okay, so this divisible pool recommends the percentage of divisible pool that should be shared with the states. Here actually 14th Finance Commission increased it to 42%, but in the later part 15th Finance Commission reduced it to 41%, the financial vertical devolution, due to J and K reorganization. Now next comes the horizontal devolution. See, now comes the tougher part, like you have to divide the states share among the states, all the states. So here the Finance Commission uses an objective formula. Okay, population from the 2011 census, area, income distance, okay, forest and ecology, income distance, tax effort, and demographic performance. Okay, this is where equity meets efficiency, and yes, it of course creates tension, especially between high performing southern states and demographically heavy northern states, but still it has to keep moving on. Okay, are these only the functions which we will be doing, which the Finance Commission does? No, there are some other functions as well. See, not all states are equal, so the Commission suggests how to give extra financial support to the needy. Okay, it also recommends ways to empower the panchayats and municipalities, which is the grassroots of the democracy, through local body funds. And this is the grants in aid, where Commission suggests how to give extra financial support to the needy, and any other matter like which is referred to by the President. Okay. One more point we can add over here is disaster relief fund suggestion. Disaster relief fund. See, when floods, earthquakes, or pandemics hit, the states need quick and fair funding. The Commission structures this relief channel too. So the Finance Commission does not just divide money, it sets the tone for the center-state coordination. Now, what is the role of Finance Commission in the fiscal federalism? Imagine a classroom where one student gets all the book and others get none. So that's what fiscal imbalance looks like, and the Finance Commission tries to prevent it. Here's how they shape the India's fiscal federalism: balancing vertical and horizontal imbalances. The Commission here ensures the center doesn't become a big brother and poor states are not left behind. Promoting financial autonomy. Here, like, states must be able to plan their own development and not keep begging for funds every time. The Finance Commission here actually enables that by ensuring predictable and rule-based transfers, promoting the financial autonomy to the states. Like, hope you guys got it. Ensuring fiscal discipline. It rewards states for efficient tax collection and sound financial planning, and also punishing the wasteful spending. Like here, because center is a Finance Commission like a big brother as well. Like, it rewards and also punishes for wrongdoing. So we have to, the states have to manage about that. Fostering cooperative federalism. The Finance Commission doesn't impose; it consults with center, with states, with the experts. See, that's real Team India spirit. Like, you have to consult with everyone and bring in a cooperation among everyone. Addressing the regional disparities. By using tools like income distance, demographic performance, it tries to uplift the lagging states without punishing the progressive ones. So, yeah, because only when the development is higher or better among the to balance the uneven development, so this economy can grow faster and reach the best place ever. Next one, strengthening local governance. Urban bodies and panchayats also matter, and the Commission funds them through state consolidated funds, because Only when the grassroots levels are funded properly, there's a topmost level works properly. So that finance commission works on that too. Next one is, yeah, facilitating disaster management. We looked into that earlier, where floods, earthquakes, or even during pandemics, finance commission make sure to work on that too. See, in short, finance commission doesn't just divide money; it distributes opportunity, autonomy, and accountability. So now let's look into a PYQ from 2023. Consider the following demographic dividends: forest and ecology, governance and reforms, stable government, and tax and fiscal efforts. So, for the horizontal tax devolution, the 15th Finance Commission used how many of the above as criteria other than the population area and income distance? So, from the previous point, we definitely did not look about or did not hear about the stable government. So, this point comes out, and the governance reforms as well. We did not think of that. Okay, but we heard about demographic performance of the state, forest and ecology taken into consider, and the fiscal discipline of the states. Okay, so this 1, 2, and 3, it's option B answer. These factual nuggets are pure prelims gold for scoring great marks. So hope you guys got with this prelims. So we are going to look into one more question here. So take your time and try to comment on this question. I'll give you some 10 seconds. So take your time, or I'll give it, or in a half minute. Take your time and try to understand the question and try to comment the answer. So did you guys, hope you guys get it. So let's go into the question. It was asked in 2025. Okay. This question was asked in 2025 prelims. Which of the following statements with regard to the recommendations of the 15th Finance Commission of India are correct? It has recommended grants of 4,800 crores from the year 2022-23 to the year 2025-26 for insensitivizing states to enhance educational outcomes. 45% of the net proceeds of union taxes are to be shared with states. 45,000 crores are to be kept as performance-based incentive for all states for carrying out agricultural reforms. It reintroduced tax effort criteria to reward fiscal performance. So this question is like looks seemingly difficult, okay? Because everything is numbers here, but except for one point where you can easily find out the answer. In the previous slide, when introducing about the Finance Commission, I told like for 14th Finance Commission brought in the horizontal devolution to 42 percentage, and 15th Finance Commission reduced it to 41 percentage, citing Jammu and Kashmir reorganization. If you have heard that clearly, you can easily crack this answer, because it says here from 15th Finance Commission 45% of the net proceeds of the union taxes are to be shared with states, which is wrong. So when you ultimately remove option A, B and D, you will get only with one answer 1, 3 and 4, which is correct. So sometimes, okay, UPSC has removed the concept of elimination from its prelims paper as well, but sometimes we have to learn, we have to keep in touch with that too. Like UPSC tests factual accuracy along with understanding of fiscal current policy is also needed for answering such questions. So let's go into the next slide. Grants in aid. Is it lifeline or a leash? What if your expenses are higher than your income? You borrow, right? We always borrow that. That's where grants and aid come in, helping fiscally weaker states to breathe. So there are two types of grants. Statutory grants. Here it's based on Article 275 of the Constitution, and its main purpose is to support the states which are in financial assistance, which is again recommended by Finance Commission's recommendations. Non-votable, they are non-votable and or charged under the Consolidated Fund of India, meaning they are non-votable by Parliament. See, it's constitutional, its structure, and it's for bridging the revenue deficits as well. Like, it provides specific grants for promoting the welfare of scheduled tribes in the state, or raising the level of administration of scheduled areas in states such as Assam. Like example, revenue deficit grants in the 15th Finance Commission, okay, helped several states like Kerala, Punjab, West Bengal as well. So that's how statutory grants work. It is provided under Article 275 of the Constitution, and it's given to states which are in need of financial assistance as recommended by Finance Commission, but it's not provided to every state, but only to those who are in need. The next one is a discretionary grant. It's provided under Article 282 of the Indian Constitution, and this article is unique as it allows both the center and state to any grants for any public purpose, even if it is not within their legislative competence. Like, see, center can give to any state at its will, like particularly for specific projects, schemes, or to meet the emergency needs. They are not obligatory and are entirely at the discretion of union government and are voted by the parliament. So remember, statutory grants are not votable by parliament, but discretionary grants are votable by parliament. So remember that thing. Historical context, like prior to the abolition of Planning Commission, a significant position of central grants to states, particularly for plan schemes who are discretionary, given based on the Planning Commission's recommendation. This often led to the concerns about centralization and reduced state autonomy. But with the abolition of Planning Commission again here, the increased tax devolution recommended by the Finance Commission, the relative importance of discretionary grants has somewhat reduced, though they still exist, is often linked to centrally sponsored schemes or central sector schemes. Like, see, these are political tools. Discretionary grants or even statutory grants, they are political tools too, which can be used to incentivize, nudge, or reward the states for following the center's direction. See, know the difference. Particularly UPSC loves testing this, and it's a game changer for GS3 Mains answer in particular. Okay, now let's look into what is the impact of GST on center-state financial relations. See, GST was introduced by the 101st Constitutional Amendment Act of 2016. It was India's biggest tax reform since independence. But was it just a tax change? No, I don't think so, because it redefined the center-state relations as well. So now let's look into some of the positive impacts. Okay, unified national market. Earlier, every state had its own VAT, entry tax, octroi. It was all chaos actually. GST brought in that simplification. So simplified. Revenue sharing mechanism. IGST ensured that tax from the interstate was shared based on destination, which is fair and also logical at the same time. You put it where you would put the tax based on the destination, not from where it is going, not from the area of the production or area of its beginning. So that's fair and logical. GST Council. For the first time, a shared decision making body, a GST Council, let states and centers take decisions together rather than only center taking decisions. So this is again a positive impact. Improved tax complaints and transparency. See, with the digital filings, e-way bills, cross verifications, GST has reduced leakages and evasion. Compensation mechanism. States feared losing revenue, so the center promised a 14% growth rate in tax revenue till 2022 and paid the difference. That built trust. It was not a perfect, but it was actually a good progress. It simplified the tax policy, but also it brought a centralized power. So let's look into some challenges as well. Okay. Any scheme which has positive impacts also has some challenges and issues as well. So loss of fiscal autonomy for states. States can no longer tweak tax rates to suit their local economies. Liquor and fuel remain outside GST for this same reason, because states cannot tweak tax rates to suit their local economies. Dependence on GST Council decisions. Center has 1/3 of vote. Even if all the states disagree, center can block the changes. That's not equal federalism. Next one is revenue volatility. Collections fluctuated wildly in early years. Compensations often came late, creating trust deficit. Cess and surcharge problem. Center increasingly uses cess like health cess, road cess, which is not shared with states at all. Now next one is disputes in revenue collection. States and center often fight over what's owed. Okay? It's not just about the money, it's about the credibility as well. Okay, so use GST as an example in Mains particular for incomplete federalism with both gains and gaps, if the question is asked. Okay, now let's look into issues in fiscal federalism. Okay, so we have now arrived at the heart of the friction, the real issues threatening India's fiscal federalism. These are not theoretical problems, these are lived realities for states struggling to balance budgets, fund welfare, and assert autonomy. Let's break them down one truth at a time. Vertical imbalance. States have greater expenditure responsibilities, but relatively limited revenue generating powers compared to the center, which controls major tax bases like corporate income tax and customs duty. See, this is fundamental imbalance in India's federal model. The states has the purse, okay, but the center has the purse, but the state has the pressure. So it should be handled properly. See, states need fund for education, health, agriculture, and all states subjects, but lack direct control over the revenue streams, which makes them dependent and not allows the empowerment of the states. Horizontal imbalance. See, it brings in uneven playing field. Significant disparities exist among states in terms of economic development, per capita income, and also the fiscal capacity. A rich state like Maharashtra earns a surplus, but a poorer state like Bihar struggles to survive. See, that's just not political, it's economic, it's political. The Finance Commission tries to fix this formula, but resentment remains, especially from efficient states that feel penalized. Okay. The debt burden of states. Many states face increasing public debt, partly due to revenue shortfalls, high expenditure commitments, and sometimes inefficient fiscal management or financial management as well. A third of some states' budget go into repaying old loans. This is not development actually, it is about only survival. Okay. The debt repayment reduces spending on welfare and infrastructure. States are stuck in vicious cycle of borrowing to repay borrowing. So you borrow to repay the borrowing which you borrowed earlier. So that's debt burden of the states. FRBM implementation, actually it's a double-edged sword. While FRBM Act aims for fiscal discipline, their strict implementation can also limit states' ability to undertake necessary expenditure. See, discipline is very good until it starts choking you. Okay, like during crises such as COVID or natural disasters, states need fiscal space. But FRBM here rules restrictive borrowing, limiting responsive governance. See, all of these issues here create a climate of tension and mistrust between the center and states. The result, what's the result? Delayed funds, political blame games, weak planning, and frustrated governance overall. So this is what we are seeing in our day-to-day life. Okay, so let's also look into some reports and commissions. The Sarkaria Commission of 1983, okay, it called for clear demarcation of powers, and Punchhi Commission of 2007, okay, actually they both highlighted on proper demarcation of powers, transparency, and greater autonomy, particularly in finance sector, more robust role for the finance commission. That's what this commission says about. RBI State Finance Report, okay, this is annual gold mine of fiscal data, okay, which shows about the fiscal health of the Indian states, okay, trends about revenues, expenses, debt levels, and reliance on central transfers as well. It frequently underscores the challenges related to vertical and horizontal imbalances in fiscal activity. Next, various state governments, particularly those with higher revenue, have often voiced concerns about the criteria used for horizontal devolution, arguing more weight to the fiscal efficiency and less to the population. This is something which we are still seeing even today. Like, use these points in answers for credibility and depth to fetch more marks as well. Okay, so yes, and there you have it. Okay, the fascinating world of center-state financial relations, a world where taxes, transfers, and trust define the future of Indian federalism. From constitution to commission, from GST to grants, we have seen how India's economic unity is shaped, and as future administrator, it is our job to understand it, critique it, and improve it. If this has helped you, do like, share, and subscribe, and join our Telegram for free notes and future updates. Until next time, this is Narayana, and you are watching Learning Through Thalaivar Way, where learning is legendary. Thank you.